Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Chris Macintosh.
Chris Macintosh, welcome to the show. Welcome back to the show.
It's always a pleasure, Tim. As we were just saying, it's been a long time, so I'm glad to be back. Good to chat to you, gents.
Where on earth do we begin, is the question.
Well, actually, what we're going to begin with is me letting the dog in, scratching at my door, because he's being a pain in the ass. So give me 1 second.
Fair enough. Nice bit of local colour there for our listeners.
I may have the same problem in a bit. We'll see. My dog starts.
That's the thing with pets.
Yeah.
Okay, where do we start? Well,
where would we have left off last time?
Well, could I just suggest that maybe for new listeners, you could tell us a little bit about what you do, just briefly, so they know who you are.
Yeah. Okay. Who am I? Well, it's funny. We're just organising an event that we're going to be running. We did a number of these, which kicked off last year, and you were familiar with it, Tim. But
This is Mavericks.
had your other implications, and we're talking about the types of individuals that we've managed to collect around us, and all of them are these sorts of individuals who basically, by and large, chose not to wear the mask, choose not to be obedient, I guess. So to some degree, that's who I am. But what I do is I run Glenorchy Capital together with a good partner and friend of mine, Brad, as well as a publication where we discuss the ideas and the implementation of our ideas that we do for Glenorchy Capital, which is both privately managed accounts as well as a traditional hedge fund structure. And that is called Insider, Capitalist Exploits Insider. So that's some of the hats that I wear. There's a few others, including the one that incorporates letting my dog into the room. But yeah, where are we at? Well, gents, I think to some degree these are... I try and scale things back and look at the bigger picture of everything, because it's very easy to get caught up in the noise and in the nuance of whatever's happening at that given point in time. And often when you look back of it, over the course of history, a lot of these things are predictable or to some degree inevitable, and largely within that context land up being somewhat like noise, and you realize that you shouldn't have been focusing so much on those little nuances. In other words, what is the Bank of England? Oh, the Bank of England just dropped rates a little bit, or the Federal Reserve might be increasing rates. But
there's not necessarily a debate about whether these institutions should even exist.
Exactly.
They're taken for granted even by city insiders.
100%. And so the bigger questions are, why is the price of money set? What is money? And we're probably diverging a little bit here, but there's, for listeners who are dialing in here, there is an epic podcast that my friend Richard Werner did with Tucker Carlson. I don't know if you guys have had Richard on, but
we're gonna have to, aren't we?
He's a scholar and a gentleman, and he does this. So I think it's probably 2 or even 3 hours long, but it's fantastic. I highly encourage everyone to just jump on to, I don't know, YouTube or wherever you want to find these things. But yeah, so Richard Werner with Tucker Carlson, and he walks you through banking, traditional banking as we know it, or as most people actually don't know it. And he educates people as to how money is created, and he educates them as to how and why stock market bubbles exist, and so on and so forth. It is epic. Anyway, back to the point. There's sort of broader questions in play, and cycles of history that always keep repeating themselves. And one of the things that we try and focus on a lot is, well, to a large extent, buying our straw hats in the winter, and preparing for the inevitability of what is now transpiring. And we know, for example, that there's I look at it as probably 4 stages of a turn, if you will, that we are in. And so and there's a couple of predictors to that. The first is that you have a monetary and a credit cycle. And in that situation, you have nations that get themselves into a sovereign debt problem. And of course, that needs to be dealt with. And then the next thing that comes along is domestic conflict. Typically, it's political disagreement. And we've always had political disagreement, but it's largely more political disagreement that can't be resolved by discourse. Now, there's a secondary, we could argue around whether that's actually by design or whether it's organic. That's a separate discussion. But the point is that these things happen, you get them, and they tie quite closely into the debt issues. And a little bit like a family that's, going through, hard times, and they start squabbling over, how many rice bowls get put out. And then the third one is that while this is all transpiring in the legacy nations of wealth, you have a rising power that challenges that existing power. And that then itself causes international conflict. Often it is preceded, the military conflict is often preceded by monetary and or trade conflict, which is what we're seeing as well. And then the fourth element to this, which isn't always there, but quite often it is, and it has in the past impacted quite significantly, and that's a technological change that assists in the disruption of that status quo. And there's many things that we could point to in that respect. Now, on the monetary side of things, you have the ability to move capital cross-border more freely without the Western legacy monetary systems. And that's being utilized. And then you have technology within warfare, things like drones. I mean, at the moment, despite what the lamestream media talk about, the Houthis in the Suez are largely controlling the Suez. This is a ragtag little army that's going up against, quote unquote, the world's largest military might. And not only challenging them, but largely dictating the rules of play. And so a lot of that is also as a consequence of technology. You can throw up $2,000 drones and have the Muppets use $1 million missiles to try and shoot them down. And so anybody can do the math on how that transpires. So, these are the things that we focus on. And then within that, you have all sorts of other ramifications, which is to say you have, valuations in certain sectors. And those have they've gotten so out of kilter. It's actually mind-blowing to me. But that's where we try and focus, gents, is on as attempting to navigate the storm that we're in by understanding those large cycles in play, not getting caught up in the noise and the day-to-day Instagram nature of people's mental acuity, but to understand those cycles and then look for the deepest value and the lowest risk with highest probability outcomes and structure a portfolio around those types of typically what is sectoral trades. We often pay quite a bit of attention, especially now, to the geographies because that becomes important, i.e. we don't go and buy coal mining companies in Germany. We buy them in Indonesia. Anyway, that's it in a bit of a ramshackle nutshell.
To what extent do you think that these various factors that seem to be aligning are happening by design or by coincidence? And so I suppose, because you have an excellent pinned tweet, which I would recommend to anybody on X. And I think without being unfair, you could say, for example, that the COVID panic didn't arise. It was not a manifestation of a health crisis. It was a manifestation of a monetary crisis. To what extent do you think these things are happening because of conscious design, or to what extent do you think it's also just a whole bunch of sort of bad actors just joyriding because they can see an opportunity?
Yeah, so there's again, I'd point folks to the podcast with Richard Werner, and Richard doesn't specifically state it. He says it without saying it, insofar as he explains how it works. He explains how the bankers create money out of thin air. He explains how where you direct your credit creation to has a significant impact on whether you actually have any real GDP growth, and whether it's positive or whether it creates bubbles. By and large, if you push capital or credit into consumption, then you create a real problem. And so there is, to answer your question, when you lay out,
I mean, maybe it's impossible to say. I don't discount that as well.
Well,
there's so many moving parts here.
It's one of those things where when you lay out what you can see is actually taking place, and it's factual and it's not debatable, then it begs the question of, well, if this is so obvious, why would you do X, Y, Z? And to some degree, the answer to that is to profit, right? There is enormous profit from bankers in a collapse, right? And there is enormous profit in a boom. If you understand the machinations of that, then absolutely you can increase your wealth many, many times over, to the degree that others wouldn't be able to participate in that because they're basically blind to it. So now, does that mean that is happening or not? We don't know, but certainly the ingredients for that seem very obvious to me. What I would say is that what we're talking about now is likely to have many people going, oh, this guy's a nutter. Where did you find him? What I would suggest is that even if that isn't by design, it doesn't really matter whether it's by design or not. You can see the repetition of that cycle again and again and again. So whether it's by design or whether it's organic, the point is you have to deal with it. And so there's two elements to this, Tim, because there's the class of people who look at it and say, this is all by design. These bastards are doing this on purpose. But they get fixated and stuck in that. And my attitude to life in general is do something about it. Life's not fair. It's not all, roses and sunshine. So you've got what you've got. Bloody deal with it. Make a plan. Do something. And so in the do something bucket, whether it's by design or not, you have this in front of you. You need to deal with it. How are you going to deal with it is where I tend to focus my energies, because at the end of the day, it's far better to be, and far healthier, I think, for you to be waking up in the morning and being productive and bringing value to the world, as opposed to sitting there and bitching and moaning and going, oh, they've got us by the balls and they're going to do this and they're going to do that and so on and so forth. So
I suppose it's a Stoic argument, which is, learn to discriminate between what you can change and what you can't, and deal with what you can change.
Yeah, and I think it's a much healthier way to live your life, and it's more productive. There's only so much that your cortisol levels can take of sitting there and complaining about how bad things are, and we live in this world of such incredible victimhood. It just drives me absolutely nuts. Stop being a victim, for goodness sake. Understand what's going on, whether it's by design or not, doesn't matter. So if we fast forward to today and we say, okay, where could one of these ramp up bubble type structures exist, and how would you escape it, and how would you protect yourself? I think that's, to me, blindingly obvious. I mean, if we look at where capital allocate, because look, bubbles require centralization. That's all it is a centralization of capital into a company or into a sector, and so on and so forth, right? To the extent that it creates more convexity. And so then when that thing does ultimately collapse, there's violent moves in multiple different asset classes. And again, if you can sort of see that transpiring, then you can A, get out of the way, or B, you could potentially profit from it. So if you look today, folks, in terms of global capital, the US accounts for about 25% of global GDP, and yet it commands 65% of the share of global market capitalization. That's pretty extraordinary. So we have this concentration of capital into the US markets. Now, if we dig into the US markets, stock market valuations are at record highs. We're sitting at about a 75-year high in US stock market valuations vis-a-vis the rest of the world. Okay, so with concentration in the US, 65%, when you've only got 25% global GDP. Then we have this 75-year high in terms of valuations. But it gets even more nutty if you take that US stock market. Guess where the concentration of the capital is in that? Well, we all know it's the Mag 7. I mean, I'll show you charts of, what's that? I think it's 490 something stocks in the S&P, and then there's the 7. and the 490 stocks basically haven't really gone anywhere for 20 years. And yet the Mag 7 has screamed higher. And then the other thing that gets even nuttier is within the Mag 7, you've got NVIDIA, which is 4.7 trillion now in market cap. It's truly extraordinary. There's some other metrics, which is to say that you could say, well, this is all US money. It's not US money. So you've got foreign holdings of US financial assets, which is at all-time highs, higher than it's ever been before. So foreigners are seriously overweight. Domestic US institutions are heavily overweight. So there's this incredible concentration. I mean, the US stock market today, guys, it's larger than, I was writing about this the other week, I'm trying to remember it now. So larger than the market caps of Europe, China, Hong Kong, Japan, India, the UK, France, Germany, Spain, Italy, Brazil, Mexico, and South Africa combined. And then, of course, you've got NVIDIA, which represents 8% of the index.
It feels a little bit like what it must. I mean, I was too young. I was still at university when the Japanese market popped in '89, but presumably it must have been a similar feeling then, which is, the statistic that everyone always quotes was that the valuation of property was so extreme that the land around the Imperial Palace in Tokyo was worth more than California.
Yeah.
And and it's like, actually, they do ring a bell at the top of the market. You just have to be alert enough to hear it.
And you have to ignore the pundits on, Jim Cramer and those clowns on TV who are just, I think they're purely there for entertainment. I'm not sure why they're there. Maybe
is he still there? Is he still going? I didn't even know if he was.
I don't know. I don't watch that.
There must be a fund that combines the Pelosi tracker with the inverse Cramer.
That's good.
Yeah.
Talking the Japanese market, that's just broken into an all-time high.
New all-time high today. Yeah. Mm-hmm. Well, every dog has his day.
I thought you were quite bullish on Japan, Tim. I mean, you were.
We held Japan. It did very well for us. We're now out of it.
Oh, you're out of it now.
Look, I like buying things that are very cheap, and it's not just because there's upside to it, but it's in large part it's risk mitigation.
What about things that are expensive that become even more expensive? Is that
sure? I miss out on them because the risk element changes.
But does it really? Is that, how's that? What's that based on?
Well, buying NVIDIA at a 55 PE to me is risky. Can it go higher? Sure. But and to be fair, if you'd asked me last year what I thought of NVIDIA, I would have said that I think it's hyped up and it's overvalued. And then, here we are today, and it's much higher. So it's not. It's a little bit like gambling, you know. The guy who walks out of the casino in Vegas with a pile of money, everybody looks at him, but they don't look at the hundreds of others that have all been slaughtered because the house is always going to win. They're always looking at that guy. So that's the NVIDIA, and that's the Mag 7 to me right now. It's far too risky. I'm not a gambler. And
I think that's a very important point, that I think a lot of people treat the markets like a casino, and they can be a casino if you want it to be a casino, but you can treat the market any way you like. So if you sort of nailed your colors firmly to the mast of, let's say, value, as we would as well. So things like NVIDIA don't make any sense, possibly as a short at some point, but that's not our game either. So we just ignore. But I think it's the perception that the market will give you what you want. If you want sex and violence, you'll get that, but it might not be very profitable for you.
Yeah, I mean, when I was saying buy expensive and sell it even more expensive, I didn't necessarily mean NVIDIA. I meant at a certain point, you know, something like the macro scene has been very bullish on, you know, risk on assets, as we've seen. And that might be, you could say it's overdone, but it has been fairly persistent. So at what point in a trade do you say, right, this is actually still going in the direction I thought it was going in, but it's on our metrics expensive. I'm just, and I think you're kind of answering it with the guy. You're the guy who walks out of the casino early, and then you don't want to be the guy at 4 o'clock in the morning trying to make his losses back. Basically,
make it back. Yeah, look, it's like someone mentioned this to me the other day. We were talking, bumped into someone. We were talking about age and stuff, and so I'm in my late 40s now, and he's like, "How do you keep in shape so much? Like you look great." And I sort of thought about it afterwards, and I thought, that question is actually, it's the same question around portfolio management. It's the same question around the returns that any individual's had in their life, because the answer to the question is discipline. So you've got to be disciplined. And we've just done a recap on we have two portfolios we run. One is the asymmetric, the other is the dividend income. Anyway, so the dividend income one, just to put this into context, this was something we set up in beginning of 21. We had clients who were looking for income, and they knew our view on bonds as being a bug in search of a windshield. And so we designed this portfolio, and it was quite simple. We said we're going to buy cheap, deep value assets that pay out a healthy dividend. And so we're buying companies with sub PEs of 8, often no or low debt, spitting out dividends from free cash flow. That's basically it. And we're pretty agnostic as to the geographies or the sectors. We just said we're not going to pay attention to that, because we pay a lot of attention to that for the asymmetric. We said, no, let's just see where these things live, and let's just go out and build a portfolio of them. So we've got about 80 companies in that portfolio. The funny thing is, now we come years later, we look at this thing, it's been very steady, very low volatility, because we have so many, like we've got 80 positions. So we're roughly like 1%-ish position sizing per equity, right? Depending a little bit market cap weighted. And boring shit. I mean, like fucking window washing companies and parts manufacturers and kindergartens, like just boring stuff, right? But since beginning of 21, it's punched out like a 60% return. And of that, 60% of the returns have come from equity revaluation and the balance from dividends, which we reinvest. Now, we never bought it for the equity valuations. We just said, we just hope the way we figure it is that we can't get run over with this. Even if some particular country gets sanctioned or some sector gets hammered, we're so diverse across the whole thing that our 1 or 2 or 5% positioning in that sector or 1% positioning in that company is going to be meaningless. It won't really bloody matter. But we pretty much every quarter to half year, we basically reevaluate it. That's how much work we put into it. I mean, it's actually not that much work, and I'm almost talking myself out of a job here because our clients pay us to manage that for them. But and we tell them the reality is we don't actually look at every day, which is I think what you should do. But we're super disciplined. So when the equities revalue higher, we just sell them because you buy something and let's say it's a 10% divvy, 12% divvy, and the thing triples. It's no longer a 12% divvy. So you go, okay, it doesn't meet the metrics, unlucky, move on. You sell it and you move on, and that discipline is what's just kept this thing going. Now, that comes back to your question, Paul, which is, can it go higher? And absolutely it can. We had one company in particular. Now, this could be, and it is sort of an anomaly, that we bought in that portfolio. It's a company called Aryt, ticker's ARYT. And they're a detonator manufacturer in Israel. Now, we bought them way back before the conflict. They were cheap. They were paying, I think it was a 15% dividend, constant. We're like, this is great. Bought the thing. Now, some of our subscribers who saw it, they bought it and they forgot about it and they didn't sell it. That's now accounts. What would have been a 1% position in your portfolio is now a 20% position. Because, well, you know what's happened in Israel. Anyway, the thing's up like 5,000% or something ridiculous. But of course, now based on its dividend yield, it's not something I'd buy. But we sold that, right? So we lost out on what are substantial gains. Now the question then is like, well, would you do that again? I'm like, yes, because that's discipline. That's the portfolio structure. That's what we do. And for every one area out there that you miss out on, there's going to be a bunch of other ones that are different, and you need to cut them off, and you need to be disciplined with it. So.
Yeah, so you're looking. You've got one example of one that's gone, 5,000% or whatever. But the majority obviously aren't going to do that. So you get out at a point. I mean, you could probably go back through multiple ones where it went up to an expensive level in your metrics. You got out and then it went down. And you wouldn't be then holding it. So, yeah.
And look, to be fair, just so people are aware, I mean, we've had shit go to zero. We landed up buying things before the Ukrainian conflict. We had some equities in there in Ukraine. And one went to zero. But, a 1% position size in your portfolio that goes to zero, it's like... It's we didn't even notice it. So it's annoying, but... So be it. But again, if you're disciplined across this and you don't, that's the other thing. And I see this with the publication of the newsletter. We'll write about a bunch of these stocks and people will, we had a subscriber wrote in and he's like, oh, you wrote about this and I love you guys. You're amazing. I bought that thing and I bought it as a 30% position size in my portfolio. And this is a small cap, like an $800 million market cap company. I'm like, you fucking nuts. What are you doing? Quick, sell it. Because it, I don't know, went up like 4 times or something. So he's very happy now. But like, again, that's the gambler. That's risky. You keep doing that and you're going to lose your shirt. So
on the merits of sort of patient buy and hold investing, I think my favorite anecdote is, I'd like to think it's a true one, but apparently Fidelity brokers in the States did a survey of their clients, and it turned out the best performing clients were dead, and their second best performing clients forgot they had a Fidelity account. So there can sometimes be merit in, let's say, sort of considered passivity, for want of a better phrase.
I was thinking exactly that when Chris was saying about how he looks at his portfolio, because the more you look at it, the more you're tempted to do something, right?
So because I always had this feeling in a dealing, not that I've been in a dealing room now for over 20 years, but that if you're, and I was in sales, not trading, but they are obviously fairly closely related. But I always had this feeling that if I were running a dealing room and a trader had a good day, he should be allowed to leave whatever time he likes and go off and play golf. Because the more you sit in front of a Bloomberg terminal, the more you're just going to be incentivized to lured into dabbling and stuff that you've probably got absolutely no clue about, because that's human nature.
Yeah, prop desks I think are pretty much like that from from when I was there. They would let them come and go as long as the performance was at a certain level. But I think the spot traders had to be there in currencies all the time, unfortunately, because they had to make a price. But they were very disciplined about how I mean, I had a lot of respect for short-term spot trading. It's a very hard job, and some of it is, you get paid by the spread, but not always. You know, they would run positions. But you're absolutely right, Tim. It's like, it's that, isn't it that study they did of taxi drivers, and they were saying that taxi drivers, when it's really busy, they knock off early, and when it's not busy, they grind the day through until they've made a certain amount of money in a day. When it would, I mean, to me, logically, what you would do is when you're busy, you stay busy, and then when the market effectively, i.e. the taxi work is low, you just say, okay, you know, it's going to come back in a cycle, and we'll just come back when it's busy, instead of trying to grind it out. So it would make more sense to do it that way. But for some reason, it seems inverted to me, and it seems so logical of what you're saying, but I don't think everybody thinks like that.
With investing, there's this idea that if you're not doing something, then, like, investing is not like digging a trench. Like digging a trench, if you stop digging, like, then the trench stops getting dug. There's a problem. And so you have to physically keep doing it. And that's just not at all like with a mental type of activity. Most of the time, you should be just sitting and thinking. You know, a lot of people will ask me, what do you do? I'm like, a lot of the time, I just read. I read and I sit and I think. And then I go to the gym and I go for a run. And many of your ideas and things that come, they don't come from sitting there trying to like grind something out. And with respect to the investing side of things, and there's, by the way, this is age-old wisdom. There's some fantastic investors that we can look back to and go and listen to their views and their thoughts. There's one that I listened to a little while back. If you're familiar with Anthony Bolton, he's got some amazing stuff that is out there. And so he was one of the best contrarian, if you will, investors of all time. And he talks about this ability to literally do nothing. Both that and the ability to do what is just logical, but that the markets or that the broad populace think is dangerous. And, you know, so, I mean, we come back to the topic that I was talking about before with respect to these overvaluations and so on and so forth. And then you could say, well, okay, how do you protect yourself? What are you doing? Well, you look at what are the ugly ducklings? And that's pretty easy as well. You know, you've got energy stocks trading about 24% below historical PEs. The irony behind this, of course, is that NVIDIA doesn't survive without energy at all.
Well, if you were having a vertically integrated portfolio, if you had to own NVIDIA, you'd also have some nuclear power stations as well.
Well, nuclear's the answer, Tim. But the problem with nuclear is that if you're going to implement nuclear in the Western world, timing's an issue. Well, first you've got to fight all the greenies. But secondly, to actually get it developed, I looked this up and I don't know how accurate it is, but it takes about 10 years to get a nuclear power plant up and running in the US. It also costs about 10 times the price of what the Chinese can do it at. So if there is a race towards AI and the base underlying AI is the cost and production of energy, then the West's screwed.
But the West seems to be screwed in so many different ways right now that virtually none of it makes sense except through the prism of controlled demolition of the economy. So I have a question that's impossible to answer, but life in Great Britain is not the bed of roses that if it ever was one, it's certainly not one now. And I don't know about Paul, but I certainly find myself looking over my shoulder, wondering whether I'm going to end up in a gulag sometime quite soon. How do you think we've seen peak insanity, or do you think we've plenty more to go? Whether it's economic energy suicide, or woke nonsense, or net zero insanity. I mean, the list just goes on and on and on. And this is all happening without any real kind of democratic mandate. I don't know what life is like in Mordor, where you are.
I think it comes back to some degree the question that you asked, Paul, which is buying something and then it can still go up. Right. The stock market to me is fascinating because it really is just a collective of a whole lot of individuals making decisions. And human beings, as we know, are not rational. So you have this, you talk about the woke and you talk about the insanity and certainly the totalitarian overreach that's transpiring at breakneck speed now. When does that end, or does it end, and how does it end, and to what degree? I think, again, it goes through these waves. I don't know where we're at in that wave. In other words, if you go back and you think about any bubble that we've experienced, let's say the dot-coms, we were all around for the dot-coms, right? So you had these crazy valuations. In hindsight, we can look at it and we can see what was transpiring. I didn't know at the time, by the way, because I was, 19 years old. I thought it was all fantastic. But it got crazier and crazier until it didn't, and it crashed. And I think that's essentially how things transpire. So the crazier that we get, the more communist that we get. I mean, Canada's just come out and they've decided that they're going to fine you if you go for a walk in the woods because it's climate lockdowns time now, right?
What?
Yeah.
What, you can't? But why can't you walk in the woods? What would that do?
Because you got to look after the woods.
Well, who's saying you're not?
Trees have feelings too, Paul. Stop being such a fascist. Trees have feelings too, Paul.
Paul, don't you look after the climate, man?
But
it's not about you.
But walking in the woods, what could that possibly do? I don't understand.
You step on bugs and you breathe. You exist.
Fucking hell, this is crazy. This is absolutely
dystopian doesn't come close.
I mean, in Canada, this is mad.
Yeah. This is Nova Scotia, isn't it?
I can send it. And, I've got some Canadian clients and, their response is, oh, well, I'm in a different state.
It's like, coming to a state near you. I mean, it's like fucking hell.
You don't understand. Like, it's all coming to you. If you don't, anyway. So, back to the point. At what point does this thing all collapse? I mean, it's like we could have looked at Mao's China and gone, well, that doesn't make any fucking sense. These people are starving and they're doing this and they're doing that. And, centralized anything, it doesn't work. But it took a pretty long time, right, before it all collapsed and then they had to dig themselves out of the ashes. Does this happen faster, sooner? We can all see it. There's those of us, the three of us on this call can see it. The problem is that you walk down the street in London there, Tim and Paul, and you're probably it'll be like a handful of people who might have a similar view to you. The rest of them are scrolling Instagram and they're worried about the latte they're going to have. And maybe worried about now getting stabbed, because you're in London. But it's, I don't know, you go through these cycles. My answer to this is, how do you escape things of this nature? For one, you don't be there. That's difficult. Of course, people have families and everything else, so there's the physicality to that. But in terms of your capital, absolutely, it's don't be there. So, and there are other opportunities. I mean, we've been trying to focus on those to allocate our capital to things and sectors and countries and geographies which are less retarded, shall we say.
Suppose to answer my own question, the awkward precedent would be Russia, or rather Soviet Russia, given that the country was sort of, or the entity, the USSR was sort of born in the chaos of the revolution in 1917, but the Berlin, and pretty much from all that time onwards, you would have objective international observers saying, well, this surely can't last. This is, this is no way to run a country. But the Berlin Wall didn't come down until 1989. So that's a lifetime if you're born at the wrong time.
That's 4 generations, yeah.
And it all imploded because of, the beginning of the end was Chernobyl, wasn't it?
You see, that's the thing. You could have been anywhere within one of those 4 generations and seen it for what it was, and it wouldn't have mattered. Your life still sucked.
Yeah.
That reminds me of if you're familiar with the Stockdale paradox.
Mm-hmm.
So is that the prison?
Go on, Paul.
Is that the prison?
Yeah, because you got this guy, I think he was Vice Admiral, and he was shot down over, I guess it was Vietnam, and he ended up in a prisoner of war camp. And I think he's talking to the guy who did, was it Jim Collins wrote Good to Great? And he was chatting to Jim Collins, and Jim Collins asked him who didn't make it. And Stockdale's response was, that's easy, the optimists. So he was obviously had multiple prisoners around him, and the guys, he said, we'll be out by Christmas, and Christmas would come and go, and they'd still be behind bars. And they said, we'll be out by Easter. And they ended up dying of a broken heart. So Stockdale made it because although he acknowledged the gravity of the situation, he was confident that he'd make it through and make it back to the States. So it's being able to take 2 different views but hold them in your mind at the same time. Acknowledge the severity, the gravity of the situation, i.e., we're in the shit, but also cling to some hope that at some point, for reasons you won't necessarily be able to articulate, things will get better.
Well, I think you need hope, because at the moment you lose hope, then
all is lost.
Depression and all is lost.
Yeah.
So that's literally a requirement for living. Then that can hopefully coincide with reality, but it doesn't have to, as is the case that you just highlighted. And so if you go and you look at historical precedent and you see where these sorts of communists, so the end of socialism is almost always communism or authoritarianism of some description. And that's what we're watching transpire. And then you can look and see, well, over what time frame have these things lasted, and when, if ever, have they turned around? The unfortunate answer to that question leaves people like us, because we're not 15 years old anymore, with the uncomfortable reality that we're probably going to be dead by the time this comes around and lands up fixing itself.
That's a cheery thought.
Well, not really. Look, at the end of the day, it's like you think about the 5 stages of grief. The last one, which is the one of acceptance. Once you accept something, you go, okay, that's what it is. Now it's actually cool because you can move on and you can actually work productively to having an outcome that works for you. And, one of the things that I highlight and I like to think about was you go through the Dark Ages. And during the Dark Ages, you had the creation of the Hanseatic League. It's some of the most prosperous city-states existed under what was a broadly problematic time.
But also the creation of some of the most incredible cathedrals ever.
And a lot of that was it was capitalism. And it existed as a consequence of the dysfunctional nature of those times, and it was born out of the chaos. And if there's one thing that seems evident to me right now, it's this incredible chaos across much of the Western world, including other parts of the world. And then, back to the topics that I mentioned right at the beginning, technology allows the ushering in of a new era. There's certainly the ability now to utilize technology to the degree that it hadn't been utilized before for freedom. I wasn't a huge proponent of things like Bitcoin, despite having bought it way back and it being easily the best investment I've ever made. Just because I'm not a Bitcoin bro per se, but what I've come to realize is that cryptography is privacy. And it transpires, it can be utilized in anything. It's just communication, right? And that is absolutely necessary in this world that we're living in, where every little move that you make is they want to have it cataloged, resourced, recorded, fed back to you, sold to you, and when you're a naughty little boy, used against you. And the answer to much of that technological overreach is cryptography. And that little world itself is growing in leaps and bounds in the same way that the Hanseatic League grew in leaps and bounds because it needed to, because it was required in that chaotic period. So I'm quite hopeful, actually, that there are solutions to some of these issues. And then, of course, there's always the situation that the world is a competitive place and capital will move to where it's treated better. And when it does, there's a feedback mechanism too, which can facilitate that, i.e., if the three of us set up our own little Paul, Tim, Chris colony somewhere, and we facilitated and made trade easier, the likely consequence of that would be that there would be 3 other gents, or 4, or 6, or 10, who would all join us and bring their own resources and so on and so forth. And that's literally the history of many places. Singapore is a good example. And so I think that there's a possibility that in this breakdown that we're watching, because we're competitive, there'll be the ability to step in and go, I'll grab some of that chocolate cake. You guys don't want it over there. And the more that takes place, the better for all of us.
To what extent are you concerned about the problem articulated by David Webb and the problem of the great taking?
Less concerned than I was before, in that when I dug deep into the functioning of many basically ledgers in that, it's far more dysfunctional and distributed than I think is required for a broad general great taking. That being said, we're already in the great taking. For example, Australia, blessed Aussies, their government came out and gave them a warning, or when was this? About a year ago. They changed the laws with respect to if you leave the country and decide that you want to go somewhere that you don't want to be taxed, then it doesn't matter. You got 3 years. They're going to keep taxing you for 3 years. So they ring-fenced that. And I remember clients going, oh, well, I wasn't going to leave anyway. So, I was like, all right, well, this is just a path. This is a trend in motion. Don't expect this to be the last thing. And lo and behold, now they brought in taxes on unrealized capital gains, right? So they first ring-fenced you for 3 years, and now they're coming out and saying anybody with over $3 million, you taxed on your unrealized capital gains. So if you've got your share portfolio that's just made $1 million, guess what? You've got a $300,000 tax bill. How are you going to pay your $300,000 tax bill? Well, you're probably going to have to sell some of your equities to sell them. So you can see where all of this goes.
I mean, the stupidity is just boundless.
Of course. But so people go, oh, well, it's not the great take. It's all part of the great. They're all taking.
So I haven't. Just a quick question here, because I haven't read it, and perhaps for listeners who haven't read the book, what's the central theme of the Great Taking?
The central theme is that you don't own securities. When you buy securities in your brokerage account, you're an entitlement holder. And so in a bankruptcy process, you will come second or third in line. So the idea behind that David Webb puts forward is that if you set a market up for a crash, and you know that a bunch of these institutions will fail in a crash, right, as a consequence of liquidity and provisioning ratios, yada, yada, yada. Then a lot of those securities will move to the ultimate beneficial owners. So actually if you go and you look at, what was that company? MF Global.
Yeah.
MF Global was a good example of that, and that's essentially what transpired. So that's the premise behind the book. And there are potentially ways you can have your securities self-custody and get them sent to, like in the old days, and have a paper transaction, and literally, it always comes down to custody, right? So that's the premise in it. And there's been a relative centralization of that within the US in particular. And that's where much of David's work was focused on. Because I've spoken with him, and so if you go into some other markets in Southeast Asia, that it operates quite differently, and he's not concerned about that. It's smaller markets and so on and so forth. So that's the premise behind the book. It may or may not transpire. I think, like anything, it's a risk, and risks, if they're identified and you have an ability to mitigate them, you do so to some degree. It's why I set up a venture capital firm a couple of years ago, or a year and a half ago now, where we're basically buying Maslow's hierarchy of needs, right? Hard assets in what we consider and deem to be counter-cyclical jurisdictions, doing a lot of stuff in Argentina. Is that the answer?
In Argentina? Sorry, I've got to cut. Why Argentina?
Gosh, Paul, you and I need to have a chat.
No, I think I know why, but just let us know. I mean, South American country with potentially high inflation, and what's the legal structure there? Maybe risky. I mean,
yeah. Look, I mean, I always like to say that risk can't be eliminated; it can be only managed, and then it can be priced. So, how do you price Argentina? Well, we know how it used to be priced, and it's being repriced. I mean, it's undergoing a profound economic transformation. It is really quite extraordinary. You've had, well, you're right. You're talking about inflation. It was running about 250% inflation annually, which is that takes a special kind of idiot to manage to get that level of inflation.
If Rachel Reeves is listening, then she can continue her world tour there.
That's the Peronists. That's the Peronists. Yeah, look, it's now about a 20% annual inflation. Yeah.
Right.
So that's brought down substantially. In fact, there's what they call the blue market. I don't know why they call it the blue market rate and the black market. But anyway, the rate between free market money on the streets and what the banks will give you, there used to be a huge spread on that. That's basically, that business has gone away. All the money changes. There's no business left.
Why is that? Do you think that's cryptocurrency or management of economy?
Well, to a large extent, Milei's gone in there and he's just stripped the bureaucracy. He's just been shredding it as much as he can. He doesn't have full control. It's hopeful that he gets that in October. They have local elections. My contacts on the ground say that it's pretty probable he'll sweep it, in which case we'll see an acceleration of that. So monthly inflation now is about 2%. It was 25% monthly. In December 23, it was 25%. All sorts. I mean, I could give you a million different examples. So, for example, the banks, you know how if you try and do banking in the Western world at the moment, and I send you, Tim, I don't know, 20 grand, inevitably the banks are going to go, what's this for? And, who's Tim? And provide me an invoice. And then if that's not like, can I see your firstborn? And it just goes on and on and on, just to move your own goddamn money. It's becoming incredibly difficult. Now, within Europe, it's still okay within SEPA, but if you move it cross-border from Europe out, it's very, very difficult. And the banks are always requesting this information from you, where they hold you hostage and they say, well, if you don't give us this information, you can't do what you're going to do. Now, in your mind, you're sitting there going, it's my money, which is back to Richard Werner's point. It's not your money. You're a creditor.
Yeah.
Because the moment you put your money in a bank, you're a creditor of what is essentially often a bankrupt financial institution. Now, I'll bring that up because in Argentina, now they've brought out saying that the banks, it's not that they are not required to ask you this information. It is illegal for them to ask you for this information. That's just one of the sort of, shall we say, liberalizing free market type of policies that is being pushed forward. So
I can see why you are revved up about Argentina. I mean, that's amazing.
Look, we actually invested in Argentina through Glenorchy back in October of 21. Milei was nowhere on the radar. Nobody even knew about him. I knew of him, but I didn't think at the time that he was going to actually win. That was not predictive to us investing there. What made us invest there was a couple of things. One, unbelievably cheap valuations, like just scarily cheap, which, to be fair, has been the case for some time. But the second component, which was the sort of kicker, was that Brazil was going through all sorts of shit fuckery and Lula was taking over. And there was a lot of country risk in Brazil. Now, I understand that if you're an asset allocator and your mandate is to invest into South America, you by and large have Brazil, Chile, and Argentina. The rest of the markets are too small. So now, as a capital allocator, when you have a huge amount of risk that is now being brought into the market for Brazil, what are you going to do? Chile had already started going super left and woke and crazy. And so I figured that there would be a certain allocation that would go to Argentina by default because it had nowhere else to go. And whether that was what happened or not, all the stocks went up. So certainly that was my rationale for actually getting in. Then as we got in, then Milei came along, and then it just started kickstarting a whole host of other things. What's interesting to me is that a couple of things. So the entire stock market of Argentina today is about 55 billion. Considering Nvidia's 4.7 trillion, there is almost no FDI gone up. Well, prices have gone up very well out of those positions. Been Argentines who have money offshore bringing it back home. That's another thing that they brought up, by the way, is what's the word? My brain's not working this early in the morning. Where individuals can bring capital back into the country without paying any taxes on it. You know, where they, in the past, they weren't allowed to.
Well, like an amnesty.
Send it offshore, but they did anyway.
Yeah.
Yeah.
I think we might have a buffering problem. Tim, can you hear me?
Yeah,
So there's been a lot of capital
down over
on
the
a home
last
turf for a good wherever it is
minute or so.
that they've.
Chris, I'm really sorry. If you can hear me, we've had some kind of buffering issue, and
Yeah, you've got all these credit ratings. So you've got like Standard & Poor's, Moody's, and all these clowns they have country risk assessments. Now, you guys, having worked in the institutional world, would know that your asset allocators sitting in Wall Street and London and all these other places, they don't know often or care about some of these countries, but they know that if it hits a certain, if it gets included in some index, then the algos are just going to buy it anyway. So when I look at a country like Argentina, there's a risk metric. I can't recall now who puts it out. I think it was JP Morgan or something. Anyway, a country, when it gets to like sort of emerging market status, which is stable enough to invest into, this particular number of basis points is around 400. That's the number that they require for a country to now, like, you know, when it hits that number, they go, okay, it's kind of stable enough. It can form emerging market status, and we can stick it in indices and yada, yada, yada. Argentina back in 2020 was like 3,000 points. Okay, so it was like so far off this. It was uninvestable. It wasn't even considered frontier market status. It was just basket case, like uninvestable. When we were in Cayman Islands a month ago, it had dropped to about 700. It's moving really, really quickly towards that 400 mark. When it hits that 400 mark, you're going to have some level of institutional capital around the world that simply just, it lands in some algo-driven system. It gets included into a bunch of indices, and these Muppets are going to go out and say, okay, well, now we allocate towards Argentina. And pray tell, what are they going to buy? You got a $55 billion market cap for the entire stock market. There's only about a dozen companies you can actually buy with the liquidity that is available for institutions. So when people ask me, you know, we're up, I don't know, 5-10 times or whatever in our money, should I get out? I'm like, why would I get out when I see that coming? Doesn't make any sense. Anyway, so that's in the listed equity space, but we're doing a lot of stuff in private equity as well, which is where there's huge opportunity, in my opinion. And again, a lot of it is just the red tape that has existed is being daily stripped away. It was impossible to do business in this country while staying within the law. That's the reality. And now it's possible to do business in the country much more easily while actually staying within the law. You know, there's environmental protections. There's just, it's actually a lesson in where I think the West is headed to. When you look at the amount of absolute insanity that exists there, and I sit there with our lawyers and our partners on the ground, and it's just, they walk you through the way that things are and have been. It's mind-blowing, which is why I can see why it was uninvestable. Absolutely, 100%. It's nuts. You can't invest in that. But yeah, so things are changing rapidly. Capital controls getting taken away. Taxes getting slashed. You name it. But there's a whole breadbasket. It has massive agriculture, mining, energy, oil and gas. The project we're working on, which is real estate up in the shale deposit. That deposit itself is the fourth largest oil deposit in the world and second largest gas deposit in the world. And under the clowns that were in power before, it was only running at a 14% capacity. Why? Because they're fucking socialists. It was impossible to operate. And so now it's ramping up, and there's just, it's boomtown. There is no supply of many things, including housing, which is what we're focused on. So I could go on, but I'll stop for the minute.
Another question that's impossible to answer, but I'll ask it anyway. How long has the fiat currency system got until it completely collapses? Because it seems to be collapsing in real time as we speak.
Yeah, I don't know, Tim. And when I get asked questions like that and ask them of myself, my answer typically is always the same, which is that I don't need to know when. I need to know the trajectory and the probability. Now the next step is purely me spending my time ensuring that I'm positioned for the inevitable, and hoping that I have sufficient of that in place before the inevitable. And that might be a year, and it might be 10 years. I don't know, and I don't think it's knowable.
But in the meantime, you favour real assets over nominal ones.
Absolutely. And it's not even that. Look, these are the cheapest assets on the planet, Tim, both on a relative and absolute basis in many instances. So even like if you were an Anthony Bolton, who didn't, to my knowledge, spend a whole lot of time on geopolitics or anything that we're discussing today, he was quite simple. He was like, I just buy cheap assets. If that was your standpoint and you said, okay, that's all I'm going to do, you'd probably land up pretty much in the same bucket that we'll ended up in anyway. So it's like, it doesn't matter which angle that you come at this from. If you come at it from a sort of geopolitical monetary collapse angle, then those are typically the asset classes that you would own. And then if you come at it from I don't know anything about politics and I don't want to know about it, but I just want to buy what's cheap, you're going to, by and large, land up with a similar portfolio. So that's my answer to it. I don't know.
Sure.
How do your value investing metrics differ? In the sense, Tim, would you be investing in or looking at potentially investing in Argentina? And do you both, I know it's a bit of a difficult question, but do you both value companies in a relatively similar way, or do you have special sauce that is particular to your own methods?
We don't really look at companies in particular as much as we look at sectors. The reasoning is because I'm lazy, by and large. So if I think about it, it's like, rather than buying the great house that's, undervalued in the street amongst a whole lot of nice houses, I'm kind of more interested in an entire street that's cheap for some reason, because I can buy the whole street. So when I look at like a sector, why there's any number of reasons why one particular company could be cheap. Could be cheap because it was run by a Muppet CEO who ran off with the money or whatever, right? There could be any number of things that have transpired behind that company. And certainly if you're going into the mining space, obviously you have a whole lot of risk with respect to geographies and all that sort of stuff. And so it's risky. Like mining's a freaking horrible business. We're buying mining companies just because that's where the value lies. But, ideally it's like, would I want to, as a business, build a business in mining? Hell no. I think it's a horrible business. You're almost always extracting, the resource, which means that you should be declining your asset base, which means that your company should be getting less valuable. But anyways, so we look at sectors as opposed to individual companies, and then within those sectors, we will go and find companies to buy. And so like if I'm looking now, there's a whole lot of metrics, which is basically, emerging markets versus developed markets. You could look at that and you can see those ratios, and you can see the peaks and the bubbles that we had, back in sort of the 90s. And the same is true if we're looking at commodity producers versus, say, broad equity markets. It's down something like 73% over the last 14 years. And, I'm reminded of the quote from Jim Rogers, which is that true bottoms in markets don't happen in 4 or 5 years. They happen over 10 to 15-year cycles. And that's often what we're like watching transpiring here. So that's, and then you can even get like small cap stocks versus large caps. Small caps relative to large caps are massively under-owned. we could walk through why I think that is, and that's down to this capital allocation that has moved for the last 20 plus, actually 30 plus years towards quote unquote passive capital. I mean, Tim, guys like you and I, we're dinosaurs, man. There's not many active funds out there. Much of the capital in the world has been moved towards passive, which
is
ETFs.
It's been ETF. So I think we're probably close to ETF, peak ETF now, which is fantastic. But either way, that's an opportunity for us. So I'm not going to lament its popularity.
No, I don't at all. But you realize that when you, like the business model for us, we have to and do operate on much smaller pools of capital. Sure. I don't know how much you've got, but like we're all the same, okay? Roughly, it's a different business model. Now, if we were an ETF, we can charge 45 basis points, but now we just put billions of dollars into it, right? So we spend a whole lot of time and money on marketing and getting capital in, and we just clip the ticket on a small fee, and there's no performance fee or anything of that nature. That's important because what it means is that all of that capital, when it gets allocated, it can't go and buy small caps. If you've got a $4 billion fund, how do you go and buy an 800 mil market cap company or even $1 billion? You can't. So they don't. So now we look at those ratios between, say, small caps and large caps, and you go, wow, that's kind of nuts. How is that possible? And you go, well, that's how it's possible. And then you dig into the small caps and you go, these companies out here that are like, they're really, really cheap and they're really profitable. And like, what's going on? Why are people not buying them? And I'll give you a quick example. I know we're running out of time probably here, but so you remember when the Chinese companies all got slaughtered back in, was it 23, I think? Like everyone decided, shit, they're probably going to do to China what they did to Russia, sanction them and yada, yada, yada. Western institutional capital that was invested into Chinese equities left. So what did they leave? What did they sell? Well, they sold Baidu and they sold Alibaba, and they sold the large equities that they could own because they had sufficient liquidity to buy them in the first instance, and they had sufficient market cap sizes to buy them. While that was transpiring, we had a roughly 30% exposure in our dividend portfolio to Chinese equities, Hong Kong in most instances. And guess what? None of our stuff got sold off. It actually kept going up. And I'm like, how is that possible when you had this? And the newspapers were all screaming about a market meltdown in China and sell-off and yada, yada, yada. No, it was Western institutional capital leaving, and they were selling what they owned. So back to the small caps versus large caps thing. It's a risk reduction to own something that the big boys don't own already, right? If they come to sell in a market crash and they start getting redeemed, they can't sell what they don't own.
Oh, that's amazing. That is absolutely amazing. I've not thought of that.
And if you're getting a 10, 15% dividend on it, do you really give a shit if they can't buy it either? Because that's the argument people have said to me is, oh, well, it's too small. I wouldn't want to buy that because it's never going to get bought by the big institutions. And I'm like, good. I don't care. If I can compound at 10% a year, I'm perfectly happy. I'll just go to the beach and not take that risk. I'm perfectly fine with that. So I think there's a lot of opportunity that still exists in this confluence of and look, to your point, Tim, a collapse in the monetary regime, we've had them before. It doesn't mean companies go away.
Sure.
So I'd rather own companies that make and produce goods and services that we bipeds need. I'd rather own that than some fiat promises from bankrupt institutions.
Was that your thought process as well, Tim, about large companies versus small? Because that's the first time I've heard that idea. That is truly, and all the pods and everything we've done, that is a very unique insight.
Well, I think there's another characteristic as well, which is, I suspect that Chris's business now is quite similar in size in terms of AUM. And the bottom line is we can invest in whatever we like. And that's not a luxury that you have when you're a multi-billion-dollar player, because Chris has highlighted there's some things that are just too small. You just can't, you would just attempting to buy them, you'd move the price. But the level at which we operate, we can take a reasonable sized stake in a small to medium sized business, and it just doesn't really change anything. You want the biggest opportunity set possible. So if you're playing a game where everybody else is playing, and you're fishing for value, and your portfolio performance will depend on whether you're overweight Nvidia or overweight Microsoft or overweight Apple. I mean, who cares? There's in the trend following world, which I admit is a slightly different animal, but I think the same opportunity set issue arises. That we have a mutual friend who trades on a trend following basis, and he says there's some markets out there that the big players can't use. So there apparently are milk futures, but most of the big players can't get invested in them because it's too tiny a market. So the more things you can own, the more choice you have, and surely more choice is better than less choice. That seems to me to be axiomatic.
Yeah, it's coming at it from another angle, in the sense that you're not forced into what everyone else is owning.
I mean, Chris has already alluded to the issue of benchmarking, but it really is a poisonous idea. It's poisonous in an equity context because, as Chris already pointed out, I think actually I think the US now accounts for something like 72% of MSCI World Index. So, and as we know, that's effectively realistic just the Mag 7. So you've got no market breadth in the US market whatsoever. It's poisonous from an equity perspective because all it's showing you is basically what yesterday's winners are. It's saying nothing about the future. But it's even more poisonous at a bond context because using the same market capitalization logic, you are forced as an indexer on a bond basis to buy the most heavily indebted country debt. That is by definition the least high quality debt. You're basically being forced to buy the crappiest debt in the world. Well,
you're being driven into what is already centralized, and you're being driven into it centralizes it more. You can see where this goes.
Because I do think there's a significant risk of capital controls. I just hope that because we're already seeing it. There's already sort of dark rumors floating around in the UK that Rachel Reeves will insist on directing pension fund assets into certain sectors. But I'm hoping that we'll be small enough to evade that. But people should think very seriously if they're part of a big scheme, because you're going to be corralled into a killing pen of basically crappy UK government debt if you're not careful.
It's any wonder why gold and precious metals have been rallying quite aggressively over the past year or so.
Well, if not now, when?
Yeah, exactly. And
it's like any of these things, what starts off as a trickle becomes a river, becomes a flood. It's just the nature of human beings, because perhaps I'm wired differently, but when we are herd animals. My daughter's got horses, and I watch these things, and they're dumb as fuck. I mean, God damn it. They're just, they will follow and do the stupidest things because they're herd animals. And then I look around me and I'm like, we're no different, really. I look at the stock markets. We go back to the COVID fiasco. I still recall walking around supermarkets. There's a friend of mine said this the other day, and I'm getting a little bit off topic here, but he was sitting, a very good friend of mine, and we both came together in the whole COVID thing to navigate the shitstorm. And he was sitting at a table with a bunch of people, all, quote unquote, educated, at a restaurant. And then every time they'd get up to go to the loo, they'd put their mask on. And he said to them, if you were told to put a banana in your ear and stand on one foot when you did it, you'd probably do it. And none of them actually even understood what he was talking about. And you realize at some point you're sitting there and you're like, I'm just surrounded by this groupthink. But that's the markets. The markets is this incredible groupthink. That's how you get things go from a trickle to a river to a flood. And so what you're talking about there, Tim, this is obvious. If you read history, it is obvious they will come and take what they can. Now, I don't pretend to know how they'll do it, whether it'll be a mandate to buy gilts through, what do you guys got? was going to say 401ks.
It's corporate pension schemes.
Yeah.
Yeah. Whether
you can have a SIP, maybe, is that's self-invested?
That's the one I was thinking of. Yeah. Anyway, and look, this isn't unique to the UK either. So these things they're inevitable. My positioning on this is, why would you wait for something that's inevitable? Start now positioning yourself as best as you can, knowing that you're not going to get everything right, but at least being aware and doing something about it now. Because for most people, they sort of go, oh, well, it's, I'll deal with that when it comes along. And then it comes along, and the next thing you know, they're corralled into the killing pen. And it's just such a victimhood mentality that drives me bonkers. But again, perhaps I'm wired differently, but I hate that thinking of, identifying an issue as you just have, Tim, and then not doing anything about it. It's problematic for me.
If we are approaching some sort of major top, perhaps, dare I say it, crash, do you have any kind of idea or sense of how far away we might be from that, or is that not a game that you play at all?
Again, it's not a game I play, because for starters, if I was a short seller, that would matter, because then that matters. I'm not. I buy long-term deep value. I'm looking for where we're going to be 3-5 years out. The rest to me is just noise. And so looking at that is a distraction for me, because it basically, quite frankly, it also just brings a certain level of anxiety. So I think it's inevitable. I know that the concentrations of capital, as we've just alluded to, are extreme. And ordinarily, those extremes get corrected in a violent fashion. Maybe this time we get lucky and it's less violent, but I don't know. What I do know is I don't want to be in the way. So then I just focus on not being in the way of that. And then I focus on trying to be in industries and sectors which are counter-cyclical and hopefully will, if not go up, at least not crater and not give me pain and suffering. I just focus on that. And everything else will be what it will be. I don't have any insights into when or how. And there's plenty of people out on the internet who will look at one thing or another, and yes, it's like a broken clock will be right, twice a day, because we don't know what that particular thing is that ultimately pops. Say something like NVIDIA. We could have gone back and we could have said, well, when the Chinese came out with DeepSeek, potentially that would have been it. And certainly there's a blip on that. You can pull up the chart and you'll see there's a bit of a blip there. And I was like, oh. Now, and there were probably a bunch of short sellers at the time who just started piling in there, and they're all been wiped out. So it's a tough game to play. I don't like playing that game, so I try not to.
I meant not necessarily positioning yourself, but looking at valuations are X, and you use valuations to decide whether one sector, one country versus another is overvalued, undervalued. And when things get to levels where you think, come on, we're so stretched now, it's likely that within a certain time frame, maybe a couple of years, we're going to see a massive revaluation, and it's all going to happen at once. But in terms of, you say that you're counter-cyclical. If there was a crash, or kind of going back to 2007, 2008 and the period after that, is that a time when you would then be looking at perhaps cyclical stocks, because you're saying that now they're bombed out and everyone hates them? I now want to jump into them.
I'll buy anything that makes sense. I mean, if we got NVIDIA, now it's a profitable as far as I can tell, well-run company. There's nothing wrong with the company. It's not a fraud to my knowledge or anything like that. It's just that a bunch of people think that it's worth more than I think it's worth, to a degree that's literally the highest we've seen in the world. 8% of global market cap. It's nuts. So would I buy that if it got down to like a PE of 3? Yeah, just like I buy anything else with a PE of 3 if it makes sense to me. I try not to. I'll just look around and see what is representing value, and then I start digging into saying I need to try and understand why that is, because I also want to know longevity of time. You can have sectors that get beaten up and they can stay beaten up for 10 years. So, which is where the commodity markets are kind of fun, just because they are very cyclical. And so, you could have gone back in, 2016 and said, oh, well, the commodity markets have come down from the 2012, 14 highs. You should buy them. Well, no, because again, they don't bottom after 2 years and then rocket straight back up. That's unusual. And there's all sorts it doesn't matter if you're looking at pharmaceuticals or biotech or anything. They've all got their own rhythm and cycle. So I try and look at that within the context of the valuations. But the valuations are what normally shows it to you. And we'll often look at things relative to other things. So like you could pull up, say, like I was saying before, emerging markets versus developed markets. So that ratio, and you go, well, wow, that just looks interesting. Because capital rotates across sectors, just because human beings do that. It's like fads. They'll get interested in blue jeans and then pink jeans are in, or bell bottoms or whatever. And that's like, it just moves from one to the other in these large mass movements. So we are invested where we are now because that's where we see a lot of the value. It's in now Chinese tech, it's in Argentina, it's in things like uranium, offshore oil, coal, shipping, precious metals. Greece we owned for the last 3 years. That's another one. I mean, like the Greek, it was just massive pessimism towards Greece. And if you'd asked me at the time, do you think Greece is amazing? I'm like, no, it's a bit of a basket case. But it's already priced for being a triple basket case. And it's been one of the best performing sectors we've owned as well. So I'll buy anything if it makes sense and I can understand the cyclicality of it. And then also to some degree, you're always looking at a portfolio and saying, does this addition of this thing I'm buying, what does that do for my overall risk profile in the portfolio? It should preferentially decrease risk always. In other words, if you own a whole lot of precious metals, miners and things like that, let's just say you have a basket of those and that's by and large your portfolio. Well, going and buying something like the Greek stock market lowers your risk profile.
Right.
Even if the Greek stock market, like that's a separate question as to whether it's good or bad, but just as a uncorrelated item, it's worth considering that. And a lot of people, I don't think, spend enough time considering portfolio allocation. And to some degree, it makes sense because it's boring. If I sit here and we do a podcast on portfolio structuring, I'll probably get like no one listening to it because it's just boring. People want to know about the next stock that's going to go 10x and make them rich. People like gambling. That's why they go to Vegas.
Yes, indeed. It reminds me of Ben Ashby's, who was on a couple of pods ago, and we haven't released it yet, but he was saying about...
To be heavily redacted is one reason why.
Well, one reason why, but the other reason is he was talking about a podcast that he does about that, and he mentioned that he does it, and he says... you shouldn't listen to it. It was just hilarious the way he was saying, You don't want to listen to it, but this is what we're talking about. It's this sort of stuff. But it's like anything, you know. I guess certain people are really drawn to that element, you know, the almost the geekiness of it. I kind of like, really. I like the details and how stuff works and how you put it all together.
Yeah, but you're an anomaly, Paul.
Yeah.
You're probably an anomaly.
And I think
that's the politest way I think I have to describe it.
Yes.
Yeah. Tim's probably going to call you a weirdo or a nerd. But
well, that's fine. That's fine. I don't mind that. I don't mind.
Rare praise.
Well, I'm nerds, by the way.
Brilliant. Well, I think we should possibly move to media picks, unless there was anything that you wanted to discuss or any questions that we hadn't asked you that you wanted to mention.
Not that I could think of. I didn't have any. I just jumped on to talk to you, Gene, so I didn't think too much about it.
No, that's cool. We're going to get your handles, obviously, before you go. Do you do much on X, or you do a bit on X?
Handles,
and I've seen.
Would that be my love handles?
Yeah. Well, you haven't got any because you go running.
No, like you did, Tim, before. I think at some point I was quite active on X, and now I think I've become a grumpy old man, to be honest. I just have no patience. So I will peruse it often for information, but I don't post that much.
Is Substack taking over, do you think? Do you think it's kind of people are shifting towards that for information?
I don't know. I mean, I know that Substack's doing well, and I'm grateful for that, because we need to have as much sort of alternative media out there. The other thing that I'm drawn towards is something like Substack has substantial, like there's a substantive nature to a lot of the content on there, whereas, you know, a lot of Twitter or I don't have Instagram or Facebook, but I suspect they're sort of similar in that it's a lot of it's sort of soundbite driven. It's that short dopamine hit rush kind of content, which I don't have time for, and I prefer. I mean, I just get friends and colleagues, and that will send me things that's important or they think is important, and often it's like it's a 3-hour podcast or something of that nature. So, so what I've ended up doing, and Lucas, who works for me, has done a fantastic job on a lot of AI stuff. But by and large, I'll just got this thing where I'll send a podcast to an email address that we've got set up, and it will transcribe it all for me, and then consolidate it and give me the bullet points. Because I can read probably 3 times faster than I can listen. I taught myself to speed read when I was like 18, and so it's been one of the best things I've ever done. So I read really quickly, and I can get through a lot of content. So that's generally the way that I'm ingesting content now. And what it's meant also is, like, I just don't post that much myself. But yeah, so Twitter I use probably less than I had in the past, and then everything else I think I've been banned on. So yeah.
Wow. Not Substack.
Banned on Facebook. Hey?
Not Substack though, surely. Are you on Substack?
No, not Substack. So we post on Substack as well, but with someone running that for me. But
so what's your Substack handle?
It'll be Capitalist Exploits Insider, I suspect. Shut that down here.
Tim, how's your Substack going? How many people have you got on there now?
Can't complain. I'm just been like 1,700 subscribers now, which is
brilliant,
and enough for someone like me. So I'm quite happy with that. It ticks over at a reasonable rate every month. So
excellent.
It's quality, not
Capitalist
quantity.
Exploits. So you're using that as well? I didn't realize you were on there, Tim. Good stuff.
I'm like a cheap tart. I'll turn up at the opening of an envelope.
Yeah.
So, should we do media picks then? Or
let's go for it.
What have you got, Tim?
So I've got one that's hot off the presses. I came across this yesterday, and I'm still trying to process it.
Oh no!
Have either of you guys heard of a guy called Donald Hoffman?
No.
Okay, so Donald Hoffman is a scientist in the States. He's done a TED talk on the nature of reality. His 2015 TED talk is titled "Do We See Reality as It Is?" And let me just see if I can find this. I was looking for Grok to summarize it. Reality is an interface. Hoffman argues that our sensory experiences, sights, sounds, textures, are not direct reflections of an objective reality, but rather evolved adaptations that simplify the world into a format useful for survival. So to get to the heart of it, the idea that, this question, this sort of metaphysical question, if a tree falls down in a forest and there's no one there to hear it, does it make a sound? Yeah, you've heard that one?
Oh, yeah.
And he would argue, no, it doesn't. It doesn't make a sound because there's no one there to hear it, and there's no mechanism for the human ear to work its magic.
Yeah.
And it gets freakier, and he suggests that objects and physical reality as we know them are merely representations created by conscious agents. Anyhow, so I bought a copy of he's written 2 books. I bought a copy of the more recent one. But essentially, his argument is that evolution maximizes for fitness as opposed to truth. So what we see of the world is nothing to do with objective reality, and it's just something that enables us to broadly favor our genetic our ability to procreate and continue the lineage. But it's a completely fascinating perspective on reality, because it flies in the face of basically everything you know about traditional scientific assumptions about an objective physical world. It's mind-bending stuff. Anyway, so
I'm just looking it up. Yeah, it's wow.
It's taken me a while just to come to terms with it, on the basis that his what he's saying has validity. But if you want the sort of the baby steps introduction to it, it's a 2015 TED talk, which is only 20 minutes long, and the title of which is "Do We See Reality as It Is?" And is a gentleman by the name of Donald D. Hoffman, who's an expert in sort of cognitive science. But it's crazy stuff.
I'm just trying to get my head round. So are we creating a reality that just kind of fits with our own, what we feel it should be rather than what it is? Is that kind of what it's saying?
He uses the analogy, for example, of an icon on your desktop. So let's say, for the sake of argument, I'm just gonna pull mine up now. So I've got an icon for Steam, which is how I download like games and software from the web. And the Steam icon is what looks like a gear on a little blue circle. So a little white gear on a blue circle. Now, what Steam actually is a whole bunch of code. But the Steam icon on my desktop, which is on the middle of the left-hand side of my screen, is not in any way reflective of what the Steam software does. The Steam software doesn't look like a little white lever on a blue circle, nor is it on the left-hand side of a computer screen. So the icon represents something, but it's not what it is. It is not that actual thing itself, if you follow the logic.
Yeah.
And his fundamental argument is that's possibly how we see the world. And I don't know if it was him that mentioned it, but either way, I heard recently from either him or another scientist that we apparently see, it might have been Jim Al-Khalili, it was something along the lines of the suggestion that we see that human vision can only see a fraction of 1% of the total electromagnetic spectrum. In other words, what we see is such a tiny fraction of the observable universe, it's laughable. And all the sum of all of this is basically we have no conception of what we even think we're seeing and experiencing on a day-to-day basis. So there's a lot of heuristics and shortcuts that the brain uses, but material reality is not necessarily what we think it is. It's probably infinitely more complex than we think it is.
I've often wondered if we've developed a appreciation of, say, a beautiful sunset, and it's beautiful because we see it as beautiful. We've kind of reverse engineered it to be beautiful because we've seen it so many times, rather than it possibly being sort of objectively beautiful. And I don't know how you define objectively in that sense, but do you see what I mean? Like,
but all of these things are massive food for thought, and probably the best way of articulating it is actually from Shakespeare, which is a line from, I think it's Hamlet, when he says, one of the characters says, there are more things dreamt of in your philosophy than, there are more things in heaven and earth than are dreamt of in your philosophy.
Yeah.
Anyway, that's a bit of profundity that we should quickly dispatch.
Well, okay, so I'll go to mine then, which is it's a film that's just been released. It's called War of the Worlds. It's
no! Have you seen the IMDb rating? It's like 3.2.
Well, no, it's not. It's 2.7.
2.7.
It's terrible. It's terrible.
I tried watching it and I gave up after 10 minutes. It's so awful.
It's so bad. It's so bad. Actually, I couldn't even get through the trailer. That's how bad it is. So, I just
Chris, if you're a fan of really bad entertainment, then this one is a corker.
I mean, is it
world?
I don't watch TV.
Galaxy class bad entertainment.
But I don't watch TV.
It's not TV. It's a film, but obviously not film either.
The film is being generous. It's a piece of crap. Sure.
But is it so bad? It's not so bad that it's, in your view, so bad that it's kind of good. Like The Room, which I think.
I don't even think it's. I think we're talking about a parallel universe of badness.
Wow.
It's not the one that becomes good because it's so bad. It's just it's like absolute bad.
How the hell did they mess it up? I mean, how?
But hang on a second. You said David Hoffman was just saying that like nothing you've seen is real. So perhaps you
Maybe
just need
great.
to see it a different way.
Yeah. Maybe you just need to be a producer.
Maybe we hallucinated seeing this film. Maybe it doesn't actually exist, Paul.
Yeah. No, there is that.
The pressure's on now, Chris.
I don't have a movie. What I have?
Anything. It can be anything you like.
No, it doesn't have to be a movie. It could be a film.
Okay.
Sorry, not a film. It could be a book or pod or anything.
All right. I got a very interesting book for people to have a look at. The Wisdom of Insecurity by Alan Watts. And
I think we're going into spirituality now, aren't we?
It's all sorts. It's he's a very interesting character. He's dead now, of course, but so in this he sort of he argues that there's a human craving for certainty and security in the world. And the more inherently uncertain the world, the greater that craving for and sense of desire for security, right? Which kind of makes sense. But what he argues is that this sort of relentless striving for a stable, predictable future actually fuels insecurity and anxiety. Now, there's something else that this tied into, which he doesn't talk about it, but because we're in this environment today, which is to say an unstable, insecure environment, or at least feels more so than it has in the past, right? I think we can all agree on that. And then I look at, the idea that we're always looking towards some utopian vision of like a safe, secure, freedom-oriented society, yada, yada, yada. Now, the tail end of that, and you can look at, I don't know if people are aware of the experiment done called Universe 25. So in Universe 25, they took a bunch of rats and they basically created a perfect universe for these rats. And what they found was that when they were given this utopian environment, all their needs were met. They had food and water and shelter and everything else. The population originally grew, but then eventually it landed up collapsing. And what transpired was Mating behaviors got disrupted. You had a whole lot of homosexuality, hypersexuality, mothers neglecting their young.
At times create soft rats.
Yeah, it was done on rats. And ultimately, the entire colony collapsed and died.
What? The whole thing?
Yeah, it's a fascinating experiment that was done. And the desire actually went away for just productive endeavors, even to the extent of sex. So again, like the homosexuality. And where there was sexuality, there was like the mothers would like, have sex and have babies and then just leave them.
Did some of the rats paint their hair purple?
Yeah.
I'm confused that if they don't want sex but they become homosexual, that's like.
Well, there was hypersexuality as well as homosexuality.
Okay.
But what was interesting was when the mothers actually did, like, where there was just hypersexuality and a lot of sex, they would leave their young often or attack their young. And you look at today, you look at these people who like letting their kids get their genitals chopped off because, they identify as a princess or a fucking whatever. I mean, how different is that to this setup? Anyways, back to Alan Watts' stuff. So he has this, I just sort of made that connection. And his whole shtick is all around our obsession with control and planning. And his message essentially is to live life mindfully in the now. And it's not about sort of a passivity, which can exist. I mean, all of us who've been to some of these sort of Pacific islands, we sit there and it's fun for like a day or two, and then you're like, what do you people do? Just sit around and you can't get anything done, and it ends up being a bit of a frustrating process if you were to live on them. But so it's not about passivity, but it's more about sort of engaging with your experiences and resisting the stress and fear of insecurity. And that it is actually insecurity which is desirable insofar as it gives us impetus to actually doing things, right? Which makes a lot of sense, right? Because you wake up in the morning, you're like, oh shit, I got to get, even if it's the most not meaningless, but like walk the dog, right? I got to walk the dog. And you can imagine for people this, and this has been tested on people who have depression, for example. You give them just little tasks to do: get up, wash the dishes, make the bed, and these little steps towards having some purpose. There was actually this is actually just brought back. There's a film I watched years ago with the kids when they were little sprogs. Gonna have to look up the name of it. It's based on a true story, and it was an English guy who was a drug addict, and he came across a cat and took in this cat and started looking after the cat, and that relationship he had with the cat basically saved his life and allowed him to get off of heroin. I'm trying to look up what that particular movie was. Now that I'm jumping around a bunch, but this was A Street Cat Named Bob. There you go. That was a great film. It was a 2016 film, A Street Cat Named Bob. It's a true story about James Bowen, a homeless man, recovering heroin addict living in the streets of London. Gets given a chance to clean up his life, gets a council flat, a stray cat comes into his place, and he basically develops this relationship with the cat. And it's what it is, it takes him away from his own thoughts to some degree, in that he's like, I've got to worry about the cat, Right. And so it's often it's selflessness, I think, if you're going to encapsulate it in one thing, which is to say you're worried about someone else or some other thing, and that gives you purpose. So you wake up in the morning and go, I've got to walk the dog, or I've got to feed the cat, or I've got to take my kids somewhere, or I've got to, like, there is a purpose to your life that extends past your own needs. And so all of those things tied together. Alan Watts's book, The Rat Experiment, and a street cat named Bob. There you go. You got 3.
Amazing. That's 1968 as well, that Alan Watts book. That's yeah. Brilliant stuff.
An oldie but a goodie.
Yeah. Fantastic. Chris, thank you so much for coming on.
Thank you, James. Thank you very much. Good to be back.
And just a reminder, your website.
So our publication business, capitalistexploits.at, A for apple, T for tomato, and then our asset management business is glenorchycapital.net.
Right, and obviously links will be in the show notes to those. Do you have people email you? How could they contact? They'll contact you via the via or via your
via the website. It's good.
Yeah, fantastic. Yeah. And you got Substack. They can sign up to that and get you. Is that how often do you update that?
Whenever we publish a newsletter, kind of every 2-ish weeks. I try not to have too much of a schedule, but it's lengthy. When I started them, they used to be sort of a dozen pages long. Typically now they're 40, 50 pages long of
what, every 2 weeks? No.
Yeah, every 2.5 weeks, something like that.
Wow.
There's always
that's impressive.
There's always stuff going on, and I'm always taking notes, and then I put it's not as hard as you think.
Yeah,
I've been doing it for years. I'm used to it.
But 40, 50 pages,
that kind of keeps me on point, you know? Well, that's what I find.
Yeah, right. Yeah.
That's what I keep, that's the lie I keep telling myself.
Yeah. No, I think the writing research it's a great way to keep you focused. Absolutely.
It's fantastic. It is. It's so good. And, you know, the thing is, we've got so many subscribers and clients and all who are super smart individuals. I mean, some multi-billion dollar asset management guys, like you name it. And so when you're writing, you realize that you're writing to these people and you can't be a muppet. So it really keeps your pencil sharp. And there's a lot of corrective process. Like I'll get feedback, you know, constantly from people in their own sectors who know more than I do about the stuff, the sectors, for example, I'm talking about. So it's a wonderful mechanism that allows me to constantly stress test what I'm thinking and doing and saying while getting a lot of input from people who actually have a vested interest in me being good, in doing well, because my clients want me to do well so I can make them money. So it's not what I thought it would be when I first started it, but I wouldn't drop it for the world. It's a great. I recommend it to anyone.
Tim, you're pretty prolific, aren't you, with your research? At least once a week.
Who have you been speaking to?
At least once a week, right? That's your.
Who have you been speaking to?
Well, I do receive it, so.
No, I mean Chris is absolutely right. The act of just putting thoughts onto, well, a screen these days rather than paper, but it's especially if you're somewhat scurrilous, it can be very cathartic.
Brilliant stuff. We'll sign off and we'll see you again. Thank you so much.
Thanks, gents. All the best.
Thanks, Chris.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.